Hello and welcome to this week's VectorVest special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic. And this week's topic is titled 10 Tactics for a Strategic Defense of Your Portfolio. And that's right, we're going 1983 Cold War defense mechanisms as we head into what looks like maybe a topping of this market that has rallied so nicely since the low back on February the 11th of this year. So with the Strategic Defense Initiative theme in mind, I went ahead and looked up the initiative definition in the Oxford Dictionary, and it tells us that initiative is an act or strategy intended to resolve a difficulty or improve a situation. So with that definition in mind, I would like to take this opportunity to help you employ an SDI of your own for your investment portfolio. Now, the goal here is to make every effort we can to maximize profits and minimize losses. And why is this important right now? Well, there are currently several reasons why it's very important to have right now a defense strategy in place, or at least a plan to implement when needed. First, in the short-term outlook, it's earnings season. And as we saw with Apple just the other day, we have to be prepared for any surprises. So we'll explore a number of tactics, some that employ some very basic option trades to help us prevent any major drawdowns. And second, our VectorVest market timing indicators, the MTI, relative timing, and the buy-sell ratio, are at 5-year highs, and the BSR is flirting with all-time highs. And while that does not mean that the market will ultimately collapse or that we'll experience some major correction, it simply means that the market may have topped, and it doesn't take much at these levels to induce some profit taking. Oh, and by the way, the market could collapse or we could experience a major correction. So we cannot predict that, but we certainly can prepare. So let's get started by taking a look at a market timing graph. Going to the VectorVest program, I'll take us to graphs, and I have here set up a 5-year look back on the VectorVest Composite price, which is here in candlesticks up top, and down below the MTI, the buy-sell ratio, and RT. And so I put a horizontal line here on the MTI, and it's hitting peaks and testing that 5-year high. The buy-sell ratio over the last couple of weeks has hit 5-year highs and flirting with all-time highs. And then finally down below we have the relative timing indicator, which is also hitting 5-year highs as well. So as I spread the graph out a little bit, we can get a better look at some of the pullbacks we do experience when these numbers tend to peak. Again, it doesn't mean the market's going to crash, although, as I said earlier, it could. So let's walk through the SDI tactics at our disposal. The first three I'm going to put on a graph and walk through these. These are pretty basic ways to use the VectorVest graphs to recognize any price behavior that would alert us to become defensive. The first is price falls below its 40-day simple moving average. Number two, if we see the relative timing indicator, or RT, fall below the level of 1 on that 0 to 2 scale. And number three, when the recommendation in the VectorVest program equals sell. So let's go back into the program and let's take a look. Now for our demonstration, I'm going to go ahead and use Apple with the understanding that these techniques apply to any stocks that we might be looking at. We'll go ahead and take this back to a 6-month graph. Currently have the 40-day moving average laid over the price of Apple here on a 6-month look back. And let's take a look at our first tactic, which is to recognize the price falling below the 40-day moving average. Now back here on the 13th of November back in 2015, Apple did fall below its 40-day moving average. You could have acted then to do several things. Now, you can consider selling the stock if you choose to. At the very least, what you want to do is be able to recognize that the stock has fallen below that moving average and perhaps place one of the other strategies in place that we're going to talk about tonight as a defensive measure. For this particular cross below the 40-day moving average, it would not have hurt you to hold on to the stock a bit longer. But as we see, it also fell down below that 40-day moving average in December of 2015, and that would have been a pretty good time to either buy a put option, tighten the stop criteria, or just simply sell the stock. The second tactic on our first slide was using relative timing as an indicator. So if I add relative timing to our 6-month graph here, we can also apply this tactic when relative timing falls below 1, as it did here back on the 17th of December of last year. If you did not sell the stock or at least tighten some stops when the stock did fall below the 40-day, certainly the second tactic or the second piece of information that we would use is the RT falling below 1. And again, as we see, the stock's downward momentum continued, and we saw RT fade pretty dramatically for Apple over the next couple of months. And finally, on our graph system, we have the ability to put the VectorVest recommendation along the top of the graph. And here we see throughout the course of the last year, as Apple shifted from a buy to a hold, it did hit the sell rating criteria, which means it fell below its 13-week moving average that we adjust for fundamentals. And so when the rec equals sell, you should be advised that we strongly urge you to reevaluate why you own the stock in the first place. When a stock falls below its 13-week moving average, again, that we adjust for fundamentals, it's a pretty good time to either go ahead and sell the stock again or take some other defensive actions before we either turn small losses into bigger losses or let any gains that we might have disappear. And let's go back to the slides and we'll continue through the top 10. We're going to address numbers 4 and 5. Next, and number 4 reads, never give back more than half of your profits, is a mantra that Dr. D has espoused for as long as I've been here, over 10 years I've been here, and I'm sure much longer than that. Our goal here is to never give back more than half of our profits, and it coincides along with technique or tactic number 5, which says we must have a profit objective once we've placed our trade. So let's go back into the graph for Apple. I'm going to make this a 3-month graph, and I'm going to change the scenario just a little bit here for us. What I'm going to do is come down to the lower left corner here, and I'm going to put the DEW timing system indicator on the Apple graph. So this is the market timing for the VectorVest Composite, and on February the 22nd, we got an up signal. So let's assume for a moment on that day, we went out and we bought some stocks, Apple being one of them. Again, this could be any stock that you may own in your portfolio. And we're going to note that on that date, on the 22nd, the stock closed at 96.88. We'll use that as our cost basis for our example. So if we combine tactics number 4 and 5, and again, number 4 was never giving back more than half of your profits and setting a profit objective. So in this case, I'm going to use a 10% profit as my objective before I employ the idea of not giving back half. So if we use 96.88 as our cost basis back on the 22nd, our 10% profit objective would be somewhere around 106.5. So I'm going to go ahead and put a horizontal line on the graph here, somewhere right around 106.5. And we'll set it right there. So at that point in the process, if I owned Apple down at that 96.88, it's now trading somewhere in the 106.5 range. To follow the technique that says don't give back more than half of my profits, I would end up placing a stop order somewhere around the 101 level, which would be 5% below that 10% profit level that I achieved. Now in this case, Apple continued to rise and hit a high of roughly 112 and change on the 14th of April. Now somewhere in this range, I could have simply added a 5% trailing stop on the stock, or I could manage it manually day in and day out. I would have been up to about 112, which would have left me at holding on to at least half of my profits from the high, getting out somewhere around the 106 level, which would have been much more preferable than watching the stock break below the moving average and then ultimately gapping down based on that earnings surprise that we saw just a couple of days ago. So being defensive does not have to mean only minimizing losses, but in this case, again, it's making sure that the nice gains we're able to get do not disappear. I'm going to go ahead and clear up the graph, and let's take us back to tactic number 6, which addresses using trend lines as an alert to when we need to become defensive on the current position. So we'll come back to our stock of the day. For our example is Apple, and we'll use the same scenario, assuming I bought the stock on the up signal the VectorVest program gave us. And I'm going to go ahead and use the extended line drawing capability that I could put on the graph. So what I can do is draw a trend line for the stock that follows the movement of the stock so that I can see that if the trend of Apple, in this case, hitting higher lows as the rally in Apple for the 2 months or so that it moved to the upside, was not broken until the 15th of April when Apple actually did close below that trend line. So it made a series of higher lows until April the 15th when it broke below that trend line, which would have been a great piece of information for me to either consider selling the stock or once again tightening the stops or taking some other defensive action so as not to allow the profit I made here disappear. Again, remember, we would have bought the stock around 96 and it was trading as high as $112 here. That's a nice profit that we don't want to go away due to inaction. Now, one key to using the trend line as your alert, what you must remember is that while you can always use the trend line and raise it as the stock continues to rise, what we don't ever want to do is take the trend line and lower it because we believe that the stock is going to come back or that there might be some turnaround. And with that, we'll go to the next set of tactics that we can employ. And these three tactics all involve using options. Now, these are some very basic, very conservative option trades that you can place, that you should know how to place for defensive measures. And we're going to start with the covered call. We're then going to talk about buying a put option to protect yourself to the downside on these positions. And finally, I'm going to go ahead and combine tactics number 7 and 8 to place a trade called a collar trade. So let's jump back into the graph and take a look at what we're trying to accomplish here. I'm going to go ahead and take RT off the graph for now. And I'm going to take the rec column off just for a moment and get us a 3-month look at the graph. Now, one thing we can do, if we look back and we'll choose a date somewhere here right around the end of March, March 29th. Again, if we had bought the stock down around that $96 and change level, and the stock closes on March the 29th, just around our 10% profit objective. Now, we could make the decision here that we want to go out and sell a covered call against our position. And so if I owned 100 shares of Apple, I could go out with the stock trading at 107.68, and I can sell a covered call somewhere around, let's use the 110 strike price. And so what that means, when I sell a covered call, it means I own the underlying stock, and I've opened a contract that says I have sold the right to someone else to take my stock away from me, to buy my stock at a higher price, which is the strike price of 110, at a later date, which would be our expiration date, probably somewhere about 30 days out. And so for this particular option, I did a little research, probably could have taken in somewhere around $1.90, maybe $2 per share to sell the 110 covered call. And again, get paid to have someone else take my stock away from me at a higher price should it close above that price at expiration. So not only would I capture the capital appreciation from 107 and change, but I would also get to keep the premium of roughly $2 for the call option that I sold. Now, tactic number 8, instead of selling the call for defensive purposes, would have us going out and buying a put option. Now, when we buy a put option, what we're doing is buying or paying for the right to sell a stock at a certain price by a certain date. That certain price is the strike price, and we're going to use 105 as our strike price. So it's below where Apple was currently trading at the end of March, when it was trading around 107 and then gapped up even higher on the next day. So I could go out and buy a protective put, and that put gives me the right to sell my 100 shares of Apple at 105, regardless of where that stock trades. Even trading all the way down here close to $90 a share, I now have the right to sell my stock at 105. Now what happens is the value of that put increases as the price of the underlying asset, in this case Apple, falls. And so that value of the option is offsetting the loss in the fact that I own the stock. Now, unlike the covered call where I actually get paid to sell the call, here, like any insurance policy, it's going to cost me money to buy that protective put. But as we often say about insurance, better to have it and not need it than to need it and not have it. And Apple is the perfect example. And finally, there is technique number 9, and this tactic includes taking numbers 7 and 8 and combining them. So we're going to go out and actually buy a protective put and simultaneously go out and sell a covered call. And what we're able to accomplish by selling the covered call, that 110 covered call that we talked about, we're able to use the income we generate there, and we're able to finance the purchase of the put option down here at 105. And in a sense, what we've done is put a collar around the price of apples. So when we combine the covered call with the purchase of a put on a stock that we currently own, the trade is called the collar trade. Now this one I'm going to go ahead and illustrate for us in the Options Analyzer tool. So what I'll do is I'll go up to the Viewers tab, and I have Apple set up in the Stock Viewer page here, and I'm going to change the date. And the date I'm going to use is April the 20th of this year. Now, the reason I'm choosing April the 20th to run the collar trade is based on the following scenario. I'm using that February 22nd date as the purchase date for Apple. If we come back to Apple and we look on April the 20th, we'll see that the stock was trading or closed that day at 107.13. Now, the reason I chose the 20th is because we purchased the stock back on February 22nd. We have a nice gain in place, and the collar trade is ideally used to protect these stocks that we already have the gains in. And I chose April 20th because, as I noted on an earlier slide, one of the reasons these tactics are so important right now is, number one, was because it is earnings season and we've got to be prepared for any earnings surprises. And so Apple turns out to be a very good example of what could happen if you're not prepared. So a week before earnings, looking at my portfolio and checking earnings dates as they approach, I noticed that Apple has earnings that are announced on April the 27th. And so just about a week before, I say I'm going to go in and I'm going to put the collar trade on for Apple. And so that's where we get our date. So if I close the graph here and I'm set my date to 4/20, I'm going to right click on the mouse, take us into our Analyze Options tab. The collar is a bearish trade, and I'm going to go ahead and choose collar. And the Options Analyzer tool is a great place to backtest or set up trades based on conditions. Just like our backtesting tool for stocks, we can look back and be able to set our trades up to set up the very best odds of success here. So when we take the information for Apple in, our trade date is 4/20. The information has to be edited. So I'm going to go ahead and edit our information lines down here. Now, the trade date is the 20th of April. Why? Because I chose a week before earnings are coming out. My first trade is going to be to short the call or sell the covered call. And the strike price that I want to use is the 110 strike. The expiration defaulted here to April 22nd. I'm going to change that out. And even though Apple trades weekly options, I'm going to use the monthly expiration here. So I'm out about 30 days. And to make this a little more realistic, I'm going to use 5 contracts for our example. And I'll click OK. So there's the first leg of our trade. I'm going to edit the second leg as well. And the first thing I'm going to do is use the 105 put, like we illustrated on the graph. I'm going to change that expiration date to the same May 20th expiration. And then finally, on our stock information line down at the bottom, I'm going to go ahead and change that to 500 shares. We'll click OK. And we'll make sure that our long put is also 5 contracts. So our information is set. What we have here on our trade date, which was 4/20, we own the stock, remember, at 96.88. We're using that as our cost basis. That was the closing price on February the 22nd. So on the 20th, we have a $5,000 profit on our stock. But I've chosen to put a collar trade on the position, and so I went out and I sold the 110, and I decided to do that so that I can buy protection at 105. So without selling the call, the put would have cost me $2.56. I was able to finance most of that cost by selling the covered call for $1.94, so this trade only cost me 62 cents to go out and buy the protection for the Apple earnings announcement. Now this trade doesn't expire until May the 20th. In the Options Analyzer, I'm able to take us into last night's closing data, and if we take a look, what we can see is that from our purchase price of 96.88, the stock closed yesterday at 94.83 and is still down from that price as we speak in today's activity. But we had a $1,000 loss on the stock itself. But because we were able to go out and employ this option trade, the call that we sold has fallen in value. From the $1.94 that we sold it at, it's worth only 6 cents right now, so I profited from the sale of that call. I was also able to protect and profit from the puts that I bought at the 105 strike for just over $4,000 on that trade alone. So when we add these up, what it tells me is on a stock purchase that I made on an up signal February 22nd at 96.88 has actually dropped, and instead of losing $1,000 on my trade, I'm actually up over $4,000 as of yesterday's close based on the collar trade that I was able to open. But I couldn't make up a better example of how valuable the collar trade can be. Remember, our profit at the time of the trade was over $5,000. We would have given all of that back had we not employed the collar. So I'm going to go ahead and close the Options Analyzer tool, and let's go back in and take a look finally at SDI Tactic number 10. And we save the best for last because number 10 says you can simply sell the stock. If you're uncomfortable with the movement of the stock's price, if you're uncomfortable with the headlines in the market, especially if you have a profit in the stock, you can always simply go ahead and sell the stock and lock in any of those profits, or again, minimize losses, right? Our goal at the outset was to keep small losses from becoming big losses and having nice gains disappear. And that's really the theme. And so this final slide puts together these 10 tactics. I put them on one slide so that you can use this as a checklist. Again, all valuable pieces of information to have. Take the time and apply these to stocks that you may currently own in your portfolio so that you have a strategic defense in place. And if you're interested in learning more about the option trades that were shown here today, you can sign up for our intermediate options course. We currently have a registration opened until May the 2nd at 5 p.m. where we have some added bonuses for you. So if you're able to register for the intermediate course by Monday, May the 2nd at 5 p.m. Eastern Time, you will get the intermediate options course, which has 6 sessions that goes over some very important concepts that are going to allow you to play all different phases and trends of the market. Along with that course, we have a couple of bonuses for you. You will also receive 4 live group coaching sessions that I have the privilege of hosting. They will be on May the 9th, 16th, and 23rd. Those are the next 3 Mondays starting on the 9th. And then on Tuesday, May 31st, I'll host it on that date due to the holiday on that Monday the 30th. Again, registration closes on Monday, May the 2nd at 5 p.m. Eastern Time. You could just type in vectorvest.com/IOC webinar to take advantage of this opportunity. We also have a bonus number 2. I showed briefly the Options Analyzer tool. It's a great add-on module here at VectorVest. It's a $495 value that we will add to your account with the purchase of the intermediate options course. Again, some of these option trades are essential in the type of market that we're seeing with uncertainty and volatility in the market. Learning some of these trades will go a long way to help you protect and profit in a rising or falling market. And so as always, if there are any questions, please don't hesitate to call product support at 888-658-7638. And again, thanks for joining me and have a pleasant weekend.